Today, folks, REITs are getting absolutely devastated in this interest raising cycle. We're going to talk about how these could potentially be a recovery play. For those of you looking at the Canadian real estate investment trust sector, we're going to review the biggest ones, the ones you guys have been asking me about, how I feel, the ones that I would potentially add to my portfolio. And if that is a conversation you'd appreciate, collecting those juicy distributions, those wonderful dividends, go hit that like button and subscribe if you're on a path to financial independence to retire early like I am. We can do this journey together, damn it. But as mentioned, REITs could potentially be a massive recovery play when the interest rate cut cycle comes around. As mentioned, REITs are disconnected from their underlying asset value, which means in most cases, you could actually buy a REIT for its publicly traded value, liquidate its entire assets and make a higher rate of return than you would be, just watching the stock flatline, right? And that's what companies are doing. Blackstone took an apartment income REIT private in a $10 billion deal because it was likely they were able to negotiate, what would be a better settlement for shareholders, but probably still well undervalued, especially as we're just on the cusp of what could be some interest rate cut cycles here. Now, on top of that, we're going to be getting some inflationary reports again this week, I think tomorrow for the Canadian side of the border, which will give some insight into the US as it always does, but it's likely we're not going to see interest rate cuts this spring as quickly as we wanted them. The real estate market has actually been relatively heating up again into spring because that's when sales start to pick back up, and everything's been holding pretty flat, which is impressive that even with a strong real estate market, REITs are trading at these ridiculous wrecked low levels, but that doesn't mean that they're buying opportunities per se, right? I don't know why REITs have been able to drop as much as they have, but we're going to look into it, because faulty inflation forecasts hold the Bank of Canada from doing any kind of rate cuts. So it's likely we're not going to see any of these recovery plays that we've looked at come out of this just yet. Now, those first interest rate cuts, though, are going to be fascinating to say the least. Now, we've talked about my favorite REITs, the ones that we personally hold between me and my fiance already, like Riocan. It's a long time one that we followed, still trading at a discount, starting to re-increase its dividends, which is great, kind of falling in line with smart centers. These are probably the two favorite of the retail REITs that a lot of people talk about, but I want to talk about the less discussed and obviously the ones that I think are even better than these two REITs, but people don't like them because the yields just aren't insane, right? You're talking about like Canadian apartment properties. I talked about this on my live stream, I believe, but for a 3.26% dividend yield where we don't get a lot of dividend increases, why am I attracted to this REIT? Well, it's able to keep up with general market performance, right? If you zoom out on the chart here over its long period of time, it performed exceptionally well. Like it was in track with market returns outpacing the TSX, doing a fabulous job up till recently. And I am a guy that looks at total returns, especially as a younger investor. So when I see a really reasonable starting dividend yield in a stock that has been able to outperform in the past, I'm going to pay attention to it, right? And obviously with little dividend increases, it's not the most exciting thing over 10 years, getting a 20% increase from 10 cents to 12 cents. Yeah, that's not the exhilarating part of owning a company like this. It's more about diversification and monthly income. This company owns 57,374 rental units. It's primarily focused when it comes to, split apartments, just anything when it comes to residential. And this is the largest residential play in Canada. The market cap today sits at around 7.6 billion. We'll talk about some of the NAV prices in a moment, but it's spread out between British Columbia, Alberta, Saskatchewan. I think Ontario here, it makes up 52% of the portfolio, which Ontario has some of the most valued real estate on the frigging planet. I noticed that it doesn't seem, well, they got some in British Columbia. I wonder if that's Vancouver based. It's a much smaller percentage. Vancouver is also a super hot real estate market. But as mentioned, there's a few reasons I like this REIT a lot. The management is absolutely stellar. As we zoom in, let's just take a look. Operating revenues continue to grow against the backdrop of a stock that hasn't moved at all. Net operating income, still up on a year-over-year basis. Net operating margins have actually increased by almost a percentage point. You take a look at the net income, however, is down dramatically, which is what most people are probably paying attention to related to earnings per share. But again, this comes down to write-downs, effects with interest rates, so much stuff. And what you really want to pay attention to is funds from operations. This really dictates, the actual cash flow in relation, which came in at about 60 cents, which was great because their distribution is only 36 cents, meaning they have a funds from operation of about 60%. Lots of room to keep that dividend protected, whereas I'm sure many people go onto Yahoo, they take a look at the statistics here, they're probably going to see a payout ratio that's at 166% and seems unsustainable. Do not trust that because it takes into consideration the net income, but not necessarily the funds from operations. So a little bit of tidbitted learning advice, but take a look at the other things here, like total debt to asset, 41%, very well leveraged, one of the best leveraged REITs in Canada. I also like the fact they don't dilute. We can see total number of units, I've actually gone down. It looks like they're buying some shares back. They're sitting on a good cash position that is depleting a bit here, but everything about this is nice. I mean, everything's moving in the right direction. You know, it's just a beautiful, beautiful company to take a look at, right? I suggest digging through it because their properties are also fun to look at, very easy to understand. And if you're just looking for monthly cash flow, I don't think it gets more reliable than this, considering how many REITs we've seen cut their dividends. So a lot of you have been asking me about things like Allied Properties. Now, Allied is kind of a mixed real estate investment trust. They do have exposure to a lot of retail like Riocan does, also paying an absolutely insane yield. The stock has fallen off a frigging cliff. I mean, they're going back to pretty much 2008 levels, like the entire housing market's completely collapsing, and they've done quite a little bit of restructuring, if I do say so myself. I mean, a lot of these REITs have had to do some restructuring. They sold some assets in which they did these massive dividend payouts. The dividend as well from 12 cents to 15 cents, not really that exciting all in all, but let's just read through it because it is not a bad REIT. Arguably, this might be one of the best leveraged REITs, but let's just kind of take a look at the leased area, which isn't actually that appealing because their leasing areas dropped off a little bit with the occupied areas. Like they're seeing a little bit of a decrease, I think, when it comes to the occupancy here. But if we take a look here, just scroll down, we can see that the investment property is valued here at what, $9.3 billion. Total assets, $10.6 billion. Their net asset value per unit is $45.60. Apparently, the stock's trading at $18.65. I do believe the NAV value for CAPREIT is on here somewhere as well. If we take a look, I think I scrolled past it. Yeah, at a NAV value and at a net asset value of $54 per share, which is down $4 or just under $4, which again for CAPREIT trading around 45. You can see that you're still getting a relative discount against the underlying asset value. But when it comes to Allied, very interesting here, you know, that their NAV is so disconnected and comparable here with their debt, their total indebtedness at 34.7%. This company, you know, 1/3 of their assets are owned, or sorry, 2/3 of their assets are owned, with that 34% of debt is insane. Rental revenue actually looks like it's increasing here on the rental front, which is incredible. You know, operating income continues to kind of appreciate here. If we take a look at the numbers that matter, funds from operation have actually been increasing. Their funds from operation payout is 73.6%, which means they can actually afford this absolutely absurd dividend, which is just, you know, jaw-dropping to me. The adjusted funds about 80%. This is crazy, right? So the question is this is a huge value setup? That's the real question. Is this company looks like it could potentially be finding a bottom here, but there's such huge risk with how much these companies have tanked. So I'm very curious to see what the interest rate cut cycle is going to do, which is why I've always felt a little bit more secure in companies like Canadian Apartment Properties, because these office-focused REITs, you know, they've done some things that have led to the stock dropping as well that you really want to dig into and get a full scope of understanding of. And I feel it's just a lot harder with these more diversified REITs, especially when you get into these billions and billions and billions of dollars. Whereas, like, you know, when it comes to just purely rental properties with residential, it's much easier to grasp as we look into Granite Real Estate Investment Trust, another very complex logistics REIT to understand. And, you know, 5 years, this thing is still doing a fabulous job. Probably another, what I would put as the second best REIT in Canada next to Canadian Apartment Properties. You know, the top three I really like are Riocan because of management. You got CAPREIT, and then you got Granite here, which with a almost $5 billion market cap and a starting yield of 4.32%. Let's just dig into it because the dividend increases not that much. I mean, over a decade, we won't get into back here when it was 3 cents, but about 14, 15 cents to about 20 cents. Again, very slow incremental increases, well diversified beyond Canada, which could take into some consideration risk with the if you're not holding this in a tax advantaged account, you might get taxed on these because typically I think you get a bit of a tax break if the rental income over 50% of it is coming from within Canada. So this is almost primarily just a U.S. operated REIT, most of their properties in the U.S., and 25% of their entire income, which is a diversification risk, comes from Magna. This is why I'm stating it's so much easier to buy something like a Canadian Apartment Properties because you're just owning an insane diversification. Whereas with this, like if Magna has issues in the future, you know, being a lot of auto parts and a very diversified manufacturer, if it ever has issues or downsizes, you know, you're going to see Granite here kind of take a hit. I'm thinking of Stag, which is the U.S. typical counterpart, a very similar logistics REIT. But yeah, Amazon has actually been growing for them at 4.1%, but not enough. Honestly, Stag to me is a better diversified version of this in the U.S. We take a look though, revenues continue to grow, which is great. Pretty much everything about this, funds from operation are going up. You know, payout ratio is only 63%, so the dividend is very secure. And even if they lost Magna, they would still be able to support this dividend and, you know, adjust and float depending on what direction they'd want to go. But honestly, I just still don't like that so much of it is heavily leveraged into that one you know, company. Whereas if we take a look at H&R Real Estate, now this is another one that went through heavy restructuring since it's completely collapsed here. And again, I just look at these are these potentially huge buying opportunities today? Because we can see it's paying about a 6.56% dividend yield. And that dividend got cut, slashed, been all over the place, probably with some liquidation of assets and paying some things out to shareholders, but still, like, what a cut here. Anybody that owned this prior has been absolutely devastated, and you can see that they've gone through massive restructuring of assets from Q2 of 2021 to Q4 of 2023, focusing more on residential than they are in any aspect of their portfolio, because, again, you have to recognize that industrial and residential are the power points of real estate today, and industrial is growing dramatically. We can see they've increased that by 8 percentage points, and 43% from 25% in residential is a massive, massive shift, which means they're trying to stabilize the asset. They know where the value exists. If we take a look here at net operating income, basically for the 3-month ending year over year has gone up slightly. On the 9-month ending has gone up pretty nicely there. Fair value adjustment in assets. Let's just scroll down here, take a look at the funds from operation. We can see that that's been increasing nicely here. The payout ratio sits at 35%. Again, fairly good numbers here. The debt to asset ratio here, the debt to total assets is 34.1%. Debt to assets at REITs proportionate share about 43%. So again, very well leveraged. I don't like seeing REITs that are typically over 50% leveraged. So again, this looks pretty nice all in all. Nothing too much to complain about. But again, if you take a look at I think the NAV value per unit is at $21.49, whereas the NAV value for this right now, or the stock value, is at $9.60. So you got to ask yourself, is that NAV value presented as a buying opportunity? I really feel like these REITs could have a potential explosion in the future because so many of them are restructured through this very tough time. And when you get, again, things like BlackRock that are looking at these, saying these could be potential buyout opportunities at value, you got to kind of see, maybe I should start adding these to my portfolio, because you could also look at something like the Vanguard FTSE Canadian CAPREIT index as a recovery play. I mean, this thing did exceptionally well leading into the recent cut cycle here. I mean, it got devastated in the pandemic and it's kind of been stuck down here. If we take a look at this, for example, just to see what the dividends are. I know this one, the largest holding, and the reason I don't like it is a service company, and the management fees are exuberatingly high. I usually like getting around 0.2% at the max. For a 2.7% dividend yield that is paid monthly, this is pretty weak, considering all the REITs we just looked at pay much higher than that. But if we take a look, when we scroll down to the holdings here, we can see that, let's get into this real quick. We can see that first and foremost, services make up 22%, so not even actual REITs. Retail REITs make up 21%, which is pretty large exposure to retail. Residential makes up about 17.95%, and industrials at 12.5%, with the top holdings being First Service, Canadian Apartment Properties, Riocan, Colliers, and Granite. And honestly, as mentioned, Granite, Riocan, Canadian Apartment Properties are probably some of my 3 strongest picks. Choice Properties is also very interesting. We haven't gone through a lot like Dream Industrial. I mean, there's Slate Grocery out there. Dream, I think, is another fascinating player here at 5.3% dividend, still trading well above the recent highs. You've got Northwest, a lot of people have been talking about as a potential recovery play that got wrecked in line with a company called MPW. MPW is one of these stocks where people think there's huge potential for short squeezing and recovery, because this is a massively shorted stock. And let's just take a look to see what the shorts say on Yahoo Finance, because a lot of REITs have been devastated with shorts. The forward dividend yield is absolutely bonkers. There's no way that's accurate, but the yield is pretty insane on this one. But if we look at the shares outstanding, shares short, the share short ratio on a percentage of float is 45.73%. So if you look at MPW stock as a potential recovery, I mean, it could explode pretty dramatically if these shorts are forced to cover. And we've seen some pretty big volatility in these kind of REITs because of that exact reason. I mean, you take a look at the last month and you had massive 18-20% volatility spikes, but it looks like a lot of people are trying to keep this REIT down, as it's already recovered 37% from the lows and is still massively, massively shorted. But there's risk too, right? I mean, these medical properties, I mean, MPW and Canadian North medical REITs are very heavily exposed to global real estate that wasn't very well managed, in my opinion, and we're seeing that reflect right now because people thought it was so stable. They got probably pretty uncertain debt that came back to bite them in the ass when it came to variable rates, I'm sure. And we've seen similar things in the office REIT sector with things like True North, a stock that was stable from 2013 onward, and it only took one event like this to completely wipe out the entirety of your returns over the last decade. There's a lot of fear with REITs, but again, that fear is something that should have been, you should have been diversifying and protected coming into this, but now's a good place to potentially cost average it, which I'll pass the question off to you. I'd love to know what your favorite REITs are and what you're doing here. I'm looking at adding Canadian apartment properties to pair it with the Riocan position here probably sometime soon, but it's going to be an interesting play as interest rates come down, and I'll pass it off to you. Let me know what you think, and what are you buying?